right, I think we're on.
Good morning. I'm going to go ahead and call this meeting to order. This is the St. Mary's County Length of Service Award Program meeting, otherwise known as LOSAP. I am Scott Ostro, Commissioner for St. Mary's County, sitting in as chair for Mr. David Weiskopf. To start with a roll call, and we'll, as Dave always does, we'll start to my left.
John Walter, Citizen Representative.
Catherine Pratson, Director of Human Resources and Board Member.
Joy Sapp, Acting CFO.
Dana DiGregorio, Administrative Recorder.
Okay, and I'm going to need a approval of the minutes from June 28th meeting minutes. Have a motion for that?
I motion to approve the August 23rd LOSAP meeting minutes
June 28th.
for June 28th, 2024.
Yeah.
I'll second.
A first and a second. Any objections? Motion carries. And we can move right into the presentation.
We may need to approve the agenda.
Oh, need approval of the agenda for August 23rd, 2024.
So moved.
A second.
I have a first and a second. Any objections?
For the record, can we correct the chair?
Sure. Yeah, the agenda references David. Sure, we can indicate
right.
that he's, so approved with the update.
Yes.
All right, motion carries. And I believe now we can move into the presentation. Mr. Pat Wayne, please take it away, sir.
Thank you, and good morning, Commissioner, and good morning, everyone else. So we have a fairly light agenda this morning from my end. We have the Q2 performance report, and then we'll walk through some recommendations given the first tranche of the fiscal 25 contribution will be made here shortly. So I'll try to keep things rather concise this morning, recognizing that I'm the opener here, and the headliner sitting behind me from Boomershine and Greg Stump. So we'll try to keep things concise so we can keep on schedule. With all that said, if you want to grab Exhibit 2 of your hard copy report, flip that over and go to page 10. We'll start where we always do. Just a quick couple comments on the economic and market environment to provide some context for how and why the trust performed the way it did during Q2. So again, starting on page 10 in the top left bullet point, at a high level, economic growth did pick up notably in Q2. We saw real GDP increase at an annual rate of 2.8%, as noted in that top left bullet point, and illustrated in the top right chart there. So what the chart is showing is quarterly real GDP growth in the bars, where the actual data are reflected by the fully colored in bars, and then the two bars to the right that are striped reflect economist estimates as we close out the calendar year. But if I can draw your attention to the last two fully colored in bars, you can see that notable uptick in growth from Q1 to Q2. And if we average those two quarters together, we come in around 2%, which is, most economist estimates for underlying trend growth of GDP. And as we look out and close the calendar year here, you can see those striped bars, just a shade under 2% or so. So economists do expect somewhat steady growth as we close out the calendar year. Now, one thing that we're keeping an eye on, if you want to shift gears and go to page 11, is the labor market, because we have seen some weakening more recently, and the data I'll reference here are through June, and then I'll make a couple comments about what we were seeing more recently with the July report that was released in early August. But as we know in that top left bullet point, despite the increase in economic activity that we saw, it does appear that the labor market began to soften in Q2. You can see we referenced that the unemployment rate ticked up a little north of 4% at the end of June, which was notably above its 12-month low of 3.5%. And there are other leading indicators that appear to signal that some softening is set to occur, and we reference that in the bottom half of that bullet point. Notably, temporary help positions are down a little less than 8% over the past year, and temporary help positions are usually a leading indicator. They're the first ones companies add coming out of a recession when the outlook's still a little bit uncertain, and the first ones companies typically get rid of when things get a little bit more cloudy, because it's much easier to add temporary workers than it is, to add or get rid of full-time workers and then refill those positions. So that was notably down from a year earlier. Again, signs of some softening, and we did see, per my comments a minute ago, and the data aren't on this page, but with the July report, a notable increase in job growth, but notably in the sense that it was below expectations. So we saw job growth a little north of 100,000, and the unemployment rate tick up to about 4.3% now. There did appear to be some one-off factors in the report, namely Hurricane Beryl impacting some of the data where the response rate to the survey was very low. And there were a lot of people reporting that they were temporarily detached from employment. So in other words, the headline numbers probably caused a little bit more of an overreaction in markets, most notably equities at the time, that came under some pressure in the wake of that report. Given those one-off factors heading into next month's report, which will be August release after Labor Day, we're likely to see some payback from a positive point of view, in that a lot of those workers that were temporarily detached likely got back into the labor market. And we've seen some signs of that with the weekly jobless claims reports, where
I thought I saw something the other day where they were walking back the amount of jobs
that's
added by a huge number.
a huge number. That's correct. So the employment report is very somewhat complex, because when you get the report numbers, that headline number that gets all the news release and the wires is what's called the payroll report. So that is essentially the survey of companies saying how many people are you adding to your payrolls. What impacts the unemployment rate is not those figures. It's a household survey, basically asking how many people in the labor force, how many people have jobs, how many people don't have jobs that are looking for jobs. So what they did, which they do every year, is essentially an annual revision to the 12 months through March of the existing year. So they just revised the 12 months through March of 2024 this year, and said that the payroll numbers that were reported were overstated by about 800,000. But that does not impact the unemployment rate, because that's determined by a completely different survey. And what was interesting is you did see this pretty big divergence over the past 12 months, where the payroll report was steadily increasing, and the household survey, which goes into the unemployment rate, was kind of steady, slowly upticking. So there was this wide gap. And now that you have this revision, more or less, they've come back into better balance. So that revision in and of itself doesn't really impact the unemployment rate data. It impacts the fact that instead of, an average of 250 or whatever the number was, 1,000 jobs added to the 12 months through March, is now closer to 160 or something of that nature. So in other words, the payroll gains appear to have been overstated. But that doesn't necessarily impact the unemployment rate data, because it's a completely different survey. But to your point, Commissioner, yes, that was a big news release a few days ago.
Does that reflect a problem with the methodology in collecting that data, or does it hint at manipulation?
I think it's a problem with collecting the data, and maybe, I don't know that they're mutually exclusive, but I can speak to the former, not the latter. What we've seen over the years is that the response rate to this survey has come way, way down. So obviously, if you have less firms responding to the survey, you're going to have a higher degree of uncertainty around what the data actually are. And then the other key figure that goes into the data itself is something called the birth-death model. At the risk of getting really granular here, each month the BLS estimates how many businesses were newly formed. That's the birth component, and how many businesses maybe, went under or died out or are no longer formed. And they estimate that to some degree via new business applications to the IRS, but it's very, very imperfect type of estimation. So you have very low response rates, and you have that other birth-death model coming into play. And what essentially happens when they do this revision, instead of using the survey, they try to match it up with the jobless claims because those are hard actual figures. And what they determined over the past 12 months, once they tried to square the two, that they had been overstating the job growth on the payroll side, likely due to those two factors I outlined.
Coincidentally, in an election year.
Coincidentally, the calendars were aligned, yes. No further comments on that. But with all that said, with some of the softening in the labor market, it has had a big impact on what the Fed outlook is. Prior to the report, and we talk a little bit about this in the bottom bullet point, prior to the report, markets were expecting the Fed to cut about 3 times in the latter part of this year. In the wake of that report, that number went way up because, again, it appeared to signify that the labor market was slowing a lot more than many had anticipated. And things have calmed down a little bit more recently as the jobless claims numbers have come in a little bit better than expected. But as we sit here this morning, right now the market's expecting a percentage point cut in the Fed funds rate for this year. There's only 3 meetings left, so that implies a 50 basis point cut at one of the 3 meetings.
Does it help us at all that anywhere in here that didn't the Fed just release they're going to lower interest?
As far as the trust itself?
Yeah.
So if we think about what the impact of that may be, and with like anything within markets, how things unfold relative to what is already expected drives what happens, right? So if the expectation is they do 4 and they only do 3, even though they're bringing short rates down, in theory, more intermediate and long-term rates could actually tick a little bit higher because they're not cutting as much as the market expects. Now, if they do what the market's pricing in or they do a little bit more, then that could be very helpful for fixed income. And as we know with the trust, since it has a very low assumed rate of return of just 6.5, we have a heavy fixed income allocation within the trust. So if rates do start coming down, probably coinciding with a little bit more economic weakness in that environment, then we would expect yields to come down and the trust to do well given that heavy fixed income allocation. But on the same side, if yields are coming down because the economic environment is unfolding more poorly than expected, that's probably an environment where equities aren't doing well. But again, when you put all the pieces together, it's a more conservative allocation. So we should get some downside protection in that sort of environment.
Okay.
So with that said, we want to jump to page 13. We'll just talk quickly about what happened in markets, and then we'll get into the trust results. We'll focus on the chart on page 13 and specifically the green bars, which are the quarterly return figures. And at a very high level, it was a much more muted and mixed quarter for capital markets relative to Q1 of the calendar year. But we'll start with the first 3 rows, namely U.S. equities. You can see we're up a little north of 3%. That was well ahead of international equities. You can see in the second row that we're actually slightly in the red. So those are international developed markets like Europe, Japan, Australia. But emerging markets actually led the way, up 5%. So again, a couple of different things than what we saw in Q1. Number one, from an absolute return perspective, more muted returns. And then number 2, emerging markets, which had lagged in Q1, actually were ahead of the game in Q2. And then U.S. bonds, per my comments earlier around being a heavy allocation with the trust, you can see we're basically flat during the quarter, up just 0.1%. So intuitively, that tells us that interest rates did increase a little bit during the quarter, putting downward pressure on bond prices. They move in opposite directions. But at the same time, the quarterly income paid and accrued by fixed income more than offset that. So they essentially,
Balance each other out.
balance each other out exactly to a flat return. A couple other quick comments here. You see high yield bonds there. We have a small allocation within fixed income. To that asset class was up 1.1%, well north of investment grade bonds. Not surprising in an environment where equities are performing reasonably well, that a riskier asset class within fixed income would outperform investment grade bonds. So that was certainly in line with expectations. And then as you continue to work your way down that page, you'll see tips about 4th up from the bottom, up just a shade under 1%, so well ahead of investment grade bonds as inflation expectations, which are a big component of TIPS returns, actually increased marginally during the quarter. And I did want to reference that because when we get back to the recommendations in a few minutes, I'm going to reference it once more because it's very different than what we've seen so far here in Q3. So with all that said, I'll pause there quickly, see if there are any more questions or comments around the market environment before we continue into the results of the trust. Okay. So we want to flip behind Exhibit 3. We'll start on page 22 here again, just a quick qualitative overview, and then we'll dig into the data on a few pages as we close out the report. But you can see up top under the observations in that top bullet point, the market value was just a shade on over $17 million. And again, we'll have a more up-to-date figure for you to review here shortly. We saw a net investment change of just under $240,000, which translated into a return of 1.3%, which was in line with the policy index benchmark per the investment policy statement of 1.3 as well. So even though they were in line with each other, there were a couple things that were helpful for the trust relative to that benchmark. That's under positive attribution. We saw outperformance by really the two active managers. Number one, Principal in the REIT area. Secondly, Baird within fixed income. However, that was offset by what you see under negative attribution. The high yield allocation to that ETF was a little bit behind the broad market. So once again, they balanced each other out. And then looking ahead, we'll take a look at the potential first tranche of that fiscal year 25 contribution here shortly. But if we look at page 23, again, we'll start at a high level with some of the data and then get a little bit more granular. But if you look at the second quarter under the summary of cash flows, that top table, you can see we began at about $16.4 million for the quarter. The net cash inflow of about $456,000, so that was the contribution less any ancillary fees and expenses. So we had that net cash flow on top of the net investment change. The trust itself grew by just a shade under $700,000 during the quarter. See the returns in the middle of the page? We'll tackle these in more detail in just a minute from a peer perspective, as we always do. But before moving on, what I always like to reference is in that bottom table where you see the asset allocation versus target, and specifically over to the right where it says within range, you see yes and green up and down across the board. So again, just a proof statement that the respective asset classes are within their board-approved permissible ranges in the IPS, so it's in compliance.
It's actually good to see all greens, because I know a lot of the times it's been.
Yeah, so, and you know what's helpful, Commissioner, is the fact that we have the fiscal year contributions on a regular basis, so it's almost a self-reinforcing mechanism for this. So we're looking at it, 6 times a year, but we're rebalancing at a minimum 4 times a year, which helps ensure that we are in compliance, way more often than not, absent some crazy thing happening in markets, in between meetings. So with that said, if you want to jump to the next page quickly, just a quick refresher on what took place during the quarter, and we'll focus here on the bottom chart that's titled Cash Flow Summary, and specifically that second column where you see net cash flow. So as you work your way up and down that column there in the bottom table, you can see broadly positive numbers, which is intuitive, right? We have the quarterly contributions throughout the fiscal year moving in. So when that cash moves in, it's essentially put to work across the vast majority of the investments. Notably, you'll see a round figure for most of the investments. Those are the mutual funds that when they pay dividends, they are automatically reinvested. That's a little different than the 2 ETFs, one of which you see in the middle of the page. That's just a shade under $25,000, and another one towards the bottom that's a shade over 16. Those ETFs, when they pay income and dividends, they're not reinvested. It's just the nature of the vehicle. They're thrown back to cash. And it's one of the reasons, really, over the past year or two, I think we've made a lot of headway moving historically, where it was pretty much ETFs across the board here, to implementing similar strategies with the mutual fund complex, and a lot of times at lower fees, to have that money reinvested back into the mutual funds and not thrown off as cash. And that also helps us keep in line with those ranges and targets per the IPS. Questions? I see a question, bro.
You may have lost me there. So I know mutual funds can be coded to automatically reinvest. Mm-hmm. Is that feature available on an ETF, or must it be manually directed?
It can't be manually. I don't know what you mean by manually directed. Do you mean to reinvest the cash after it's thrown off? Mm-hmm. Yes, the latter. So for a mutual fund, you can have it automatically reinvest the dividends and the capital gains. For ETF, that's not an option. They automatically throw it off because they're tradable securities, just like a stock security. When it pays a dividend, you can't automatically reinvest it. It gets paid to you in cash, and then you would have to buy back the shares. So that it's the same dynamic there with ETFs.
And then to the second part of what you said, should we be reinvesting that?
Well, we are over time to some degree. So you have the money thrown into cash, and if cash is building up, then the next time we meet, we usually source some of the reinvestment via the cash back.
But it
in.
doesn't necessarily go back into what produced it.
Correct. We take a look at where things stand and then make that determination.
Because you never want to have too much cash on hand, right? I mean,
Correct.
it's not serving you any purpose.
Well, right now it's still yielding north of 5%, which isn't far off of the assumed rate of return. But to your point, Commissioner, previous to the last couple of years, it was not providing much purpose when it was yielding 0%. Absolutely. And you always want to keep some cash for ancillary, fees, expenses, and things like that. So with that said, if you want to jump to page 26, we'll just talk quickly about the returns at a high level and then run through the underlying funds. But as you all know, this is a peer analysis page, one where we're trying to get as apples to apples as we can. So the title of the chart shows you the universe. So we're doing investment metrics, public defined benefit funds less than $50 million. And as always, a lot going on this page, whereas the key data are really the bottom two rows in that bottom table where you see the circle and the triangle. So as you work your way from left to right there, you see the returns I referenced earlier at 1.3 for the fund and 1.3 for the policy index, and then the rankings are in parentheses. So the fund itself was a little better than the median during the quarter. The median was 1.3, but due to rounding, we were a little bit better than that. Again, lower numbers there are better. I won't belabor the longer term returns. We talked about them at length at the last meeting and made some policy tweaks around that to try to get into a little bit better balance with the asset allocation and, not necessarily more in line with what peers are doing because obviously the trust is unique in its characteristics and constraints and needs, but it was a positive sign to see a little bit better number in Q2. And it does look, we don't have the data, but the changes the board approved, at least early signs that are working fairly well because fixed income is doing quite well this quarter. And since we have that lower assumed rate of return, we have a little bit more in fixed income because we can be pretty conservative and rates have come down notably. So in that type of environment, having more in fixed income than a lot of the other funds in here because they have higher targets and need to keep their foot on the gas pedal a little bit more. That's an environment we would expect the fund to do well, and that's what's played out here so far. But we'll review that data once the quarter's complete and we have it later in Q4. So with that said, unless there are any questions or comments, we can go to page 29, and I'll just quickly review the underlying investments. And since most of these are index funds, there's not too much to speak of. So up top, again, you see the total fund composite returns. Those are the data we reviewed on the peer page. Then anytime you see another darker row there, whether it be U.S. equity, developed non-U.S., or emerging, in those three darker rows, all of the underlying investment funds are index funds, so they should be tracking those returns fairly closely, which they do over time. There's a little bit of a divergence within emerging markets all the way down towards the bottom. And if the board recalls, it was over the past year where we moved from an ETF to a mutual fund, and there were a couple days period where it was sitting in cash and the market went up a decent amount. So that's why the returns are slightly behind there, but that'll wash out over time now that we have the mutual fund and it's reinvesting those dividends back into the fund regularly. And then finally on page 30, just to wrap up here on the report, you can see the real assets composite up top. So that is comprised of the REITs, the infrastructure, and TIPS. About 30 basis points ahead of the benchmark there owed to REITs. The next darker row, you can see principal there. The REIT manager was actually slightly positive, whereas the broader asset class was down by 1%. That's usually what we would expect from them in a more difficult environment. They tend to provide a little bit more downside protection, capture most but not all of the upside. But if you can provide the downside protection, you essentially have to dig yourself out of a shallower hole. It's easier to compound those returns over the long term. As far as infrastructure tips, not too much to speak of there. Index funds broadly in line, and then finally fixed income there also in line with the benchmark. The Fidelity U.S. Bond Index Fund in line. You can see Baird in line slightly ahead as well, but then that high yield ETF towards the bottom, slight underperformance counteracting what we saw from Baird during the quarter. So, by and large, I think, what we would have expected to play out did play out given the environment, the asset allocation. So that wraps up my comments as it relates to the report. But as always, happy to address any comments or answer any questions before we move on.
Well, it looks here, just from looking through this, that your crystal ball is pretty well calibrated. I mean, it seems to be
Well,
moving along pretty well.
I'm waiting for Mr. Walters to do the broken clock saying here. But things have, more recently, things, I think from Q2 and
It's settled down a little bit. So
yeah,
it's
it's
a little
only
bit
in
more
Q3
predictable.
now. The back half of the year, and we'll talk a little bit about this yesterday with some of the uncertainty as we get closer to the election. And historically, we're in a period now where seasonally September, October has provided some surprises, I'll call it, historically in markets. And during an election year, they tend to be weaker months because there's the uncertainty. And then once the election's over, the uncertainty's lifted and things kind of settle down more. So the next 2 months may be a little bit, hairier than what we've seen more recently. But, just given what history has argued. And I think when we get to the recommendations, we'll be able to see a little bit of that dynamic with what we're proposing.
Okay.
I move to approve the second quarter report for the length of service
Second.
awards program.
I have a first and a second. Any objections? Motion carries.
Okay. So the last item, as always, you'll find a single page in the back of your report. So right inside that hardback cover will be titled Fund Allocations. So these data are as of the close of business last Friday. And you'll note that the total assets of the LoSAP in that second column there, call it 17.87 million. That's up from, again, 17.1 at the end of Q2. So a decent start to the new fiscal year for sure. And before I get into the rebalancing specifics in the middle column in that table, please note that under that total assets column, all the way at the bottom where you see the money market fund market value of just a shade under $450,000, we're assuming the 250 is already in there to try and give you an easier way to digest there. The deposit actually hasn't been made yet, but we're counting it right now to kind of better illustrate, where the money should go. So with that said, if you circle back to the rebalancing column, what you can see here is, pretty straightforward. The first three deposits or partial contributions at $75,000 for both U.S. and non-U.S. index funds and 25 for emerging broadly bring them back to target. A little bit of a distinction within real assets. We are proposing a slight trimming of principal. The REIT fund. REITs are up more than 11% this quarter. So they underperformed in Q2, but so far in Q3, we've seen a massive shift in asset class performance. So the fact that they're up 11% in 6 weeks seems like an opportune time to maybe trim those gains a little bit and have them go back down to the 2 rows below that, back into tips, which, as I mentioned earlier, did quite well on a relative basis in Q2, but in Q3 have come under some pressure. They're posting gains, but underperforming broader fixed income. So kind of the reverse of what we saw in Q2.
Any insight onto what's driving the change?
As far as tips?
Yeah.
So essentially, inflation expectations have come down now. So when you think about the tips return relative to investment grade, if inflation expectations are increasing, that tends to be a tailwind and vice versa. So what we've seen with this quarter with some of the weaker economic data around the labor market, what's essentially happening is if you have a weakening economy, all else equal, that should lead to lower inflation moving forward. So that's really what's been driving tips to underperform. I still think they're up. Maybe it's around 2% this quarter, but the broad investment grade market's up around 3.5%. So on a relative basis, they've lagged a little bit. So this is more of a sell high, buy low within that asset class.
Okay.
And then finally, down below, you can see the contribution to the Baird aggregate bond fund, and then all of those various contributions and redemptions being sourced from the $250,000 in cash, which in turn, if you look at the bottom right table, and specifically the column all the way to the right where you see the difference, so red there is indicative of an underweight and vice versa for green, you see things mostly on target, where the slightly more conservative aspect comes into play is really towards the bottom, where you see about a 40 basis points overweight to investment grade being offset by the underweight to high yield, just per my comments earlier. If things don't, if things get a little bit more volatile here over the next couple months, high yield tends to do very well when equities are doing well, and then tends to underperform if equities are experiencing some volatility. So per my comment around, managing the uncertainty dynamic, that's really the outcome of that, being underweight a riskier asset class within fixed income and overweight its safer investment grade counterpart. And all the summation of all those recommendations are on page 2, again, where the money is going and where it's being sourced from. But with all that said, again, I'll pause once more for any comments and or questions.
It's pretty straightforward.
So I move to approve the rebalancing recommendations as proposed. And then these are following the contribution,
Yes.
the county contribution to the trust.
I will second that.
Have a first and a second. Any objection? Motion carries.
All right. Thank you.
You. Now it's time for the big show. The big shoe. So this is Boomershine, right?
Same seat.
Same seat, the hot
Please.
seat.
Yes, please.
I sold the camera and everything.
Thank you.
I have to sit there.
Please speak into the microphone.
I'm glad you have that, just in case.
I do, yeah.
So, I'm Greg
Please,
Stump.
yep. Please make sure you're speaking into the microphone. Sorry
about that.
Our folks at home our massive
Yes.
audience at home can hear us.
Understood.
Yeah, thank you.
I'm Greg Stump, Brimmershine Consulting Group, the actuary for the fund. And I'm just going to give you an actuarial update today. There's a few items on my list here. Plan overview, valuation review. Valuation was as of June 30, 2023. Plan maturity. It's an interesting topic. Asset smoothing and some funding projections. So on page 4, just looking at the history of the funding of the plan, obviously there were no assets a decade or so ago. Now it's been improving exponentially to the point where the plan is 60% funded. So that's some pretty significant progress over that amount of time. So that's good. And if you're wondering, what happens from that point forward, I will answer that question later. The current cost profile on the next page is now the cost of any type of pension or similar arrangement is always broken down into 2 pieces. There's I'll do the big one first, the amortization. So that means to the extent that you do have an unfunded liability, like that red line on the prior slide, there will be an amortization payment. If that red line, or when that red line goes all the way down to 0, that part completely goes away. It would be temporary because we're always dealing with a moving target. But the fact that there's a $10 million unfunded liability means there's a significant amortization payment still. The other part of the cost is what we call the normal cost. So for anyone who's accruing benefits, there's a cost to that each year. So if you're accruing one more year of benefit, we put an actuarial present value on that, put everybody together and say, okay, that's the normal cost. So that's really all there is. That's the 2 pieces of the funding. Now you read the valuation report and there's all these numbers and there's 25 pages of all these terms, but it really just breaks down to that. So that's where we are now. Going forward, you'll see that amortization piece become a much smaller part of the pie. So valuation review, now this is a valuation that is done once every 2 years. So in 2021, thank you, on page 7 there, that valuation was done by the prior actuary. So we just pulled those numbers from their report. When we started this contract last year, we also ran that valuation ourselves because that's a necessary step when you start a new client relationship, to make sure that we're coming up with something reasonably close to that. We're not going to match to the dollar, but we did. We came reasonably close, so we said, okay, we trust their numbers. Then moving forward to 2023, all the numbers in that column were produced from our valuation. So benefits paid is for fiscal year 23. That came directly from the county. Market and actuarial value of assets, I'm going to get to that subject more in depth soon, but it's the same number for now, and we'll talk about that. The actuarial accrued liability, kind of in the middle of the page there, that's what you're comparing to the assets. So for anyone who is not accruing a benefit, their actuarial accrued liability is just the present value of what we expect the fund to pay them the rest of their life. That's the simplistic version. For anybody else, if you are accruing a benefit, let's say we assume you're going to accrue a benefit for 10 more years. The accrued liability is just what you've accrued so far, and the normal cost is a piece, for each one of those 10 years going forward. Okay. So again, put all those numbers together, we get the plan's actuarial accrued liability. What we'd like to see is the assets move just as much or more than the accrued liability, one valuation to the next, and that's exactly what happened. So assets from 8 million to 13.5, a little more than 13.5. Accrued liability actually is down a little bit from one year to the next. And so that's where that big uptick in the funding came from. Okay. I said 10 million earlier. It's not 9.2 million is the unfunded liability.
Greg, may I ask a quick question?
Yeah, sure.
So I know we changed the benefits, we improved the benefits. Is that reflected here, or is that after?
If we knew about it by the time we did this valuation, then it would be reflected.
I'm just thinking timing, I'm sorry. I think it was, do you remember? I think it was July 1 of last year was when the new benefits took effect.
Then yeah, we would have that in there.
Okay.
Yeah.
Okay.
Yeah, and we would say that in our report also. Yeah, and in the full written report, like the 25-page thing, we would say that in the benefits section.
Okay.
And now there are times when, not here, but for other clients that we work with, where we'll find out something really late in the process. They'll say, oh, we changed these benefits, and we're just about to hand in the report. So we'll go and put something in the report that, we understand this was changed as of July 1st or whatever. It's not reflected here yet. Mm-hmm. So it should always be clear in the full written report.
Okay. Okay. Thank you.
Good question. Thank you. And with the big uptick in the funding, that contribution goes down. So the proportion of the amortization payment may still be 3/4 of the total, but the amount of it is lower. The changes in the next slide is number 8. Changes in the population. Just something we track valuation to valuation is, how many active volunteers do you have, and how did that change over the course of the year? So you have new people entering the plan. Some people are moving to retirement status. Some die. Other changes are usually just things like data corrections, data adjustments. It's kind of unavoidable with the 1,400 people in the plan. That's that last line there. So we see that the active population is larger, in 2023 versus 2021. And the total population is larger because of that. The rest of the lines are pretty comparable in terms of, retirees, beneficiaries, et cetera. Okay. And a further breakdown to that, demographic summary, it's on the next page, where we see, and things I like to look at here are, how do the average ages change? And so what we see is for the active part, 37.6 versus 38.4. So over the course of 2 years, that average age went up a little bit less than a year. That's good. A lot of times you'll see it go up 2 years in the 2-year time period. Average service is down. So you have more people moving to retirement status replaced with volunteers with just less accrued service. Vested participants, not a whole lot of change there, just one difference. That did kind of move the needle on the average age just because it's such a small group. So you change the denominator and you get a higher average. Retiree and beneficiaries, total number down a little bit, but the average age is down a little bit also, and the average annual benefit up slightly, and that's just kind of par for the course. We expect the average benefit to just go up over time. And again, total participants up 130. So related to this is my next topic of plan maturity. So we'll look at page 11. And on the left side of this, there is a graph of the amount of history that we had. You know, we'll build this to show a bigger picture over time. But what we see is what actuaries would consider a mature plan. And what we mean by that is the orange bars are bigger than the blue bars, meaning the people that are inactive represent a bigger portion of the plan, not by head count, but just by the value of the liability. So it was somewhere close to 70% for the last two evaluations, and then because of that influx of new volunteers, it's slightly less mature now. But anything over 50% is considered mature, over 50% inactive. The graph on the right is just kind of another way that we look at plan maturity. The net cash flow is the green bars on the right for each one of those years. And even though there's only evaluation done every 2 years, we still know the cash flows. We still have the asset information. So you don't need evaluation to get the one on the right. The disbursements, mostly benefit payments, but also expenses, and contributions, compared to each other, it's been what we call positive cash flow. Does not take into account investment returns. That's going to bounce around a lot. But just what's coming in and what's going out, it's been positive cash flow. As the plan gets better funded and probably more mature over time, you'll see that at some point it's going to flip to negative cash flow. And it'll present more issues for Pat than for us, but it's just something that we track in our
Something to look forward to, sir.
And I'm sure you probably deal with a lot of, mature plans.
Well, we deal with it on the OPEB that we'll talk about.
Yeah. Next topic is something I decided to include here, asset smoothing, because two things. Number one, this plan doesn't use any asset smoothing. There was never any need to. And when you're 13% funded, 40% funded, it really doesn't matter. If you have a really good year or a really bad year, you're not moving the needle that much. But now we're 60% funded and going to be 80% sometime in the not too distant future. That's when you really need to think about asset smoothing. So let me explain what it is. First of all, I hate the term asset smoothing. It's a term that's been used by actuaries for decades and decades. You can't smooth assets. Your assets are what they are. It's contribution smoothing, but it's been called asset smoothing. So the purpose of asset smoothing is when you do have that critical mass of funding, let's say 75%, so that when you have a really good year in the markets, you don't drop your contribution all the way down to zero, and when you have a really bad year in the markets, you don't double the contribution. You smooth it out, and how it works is you just recognize each year. It can be done every 3 years, 5 years, 7 years, whatever. 5 years is by far the most common, and for good reason. So you just recognize each portion of gain or loss over a 5-year period, and they're expected to kind of balance out over time. It's pretty rare to see 5 consecutive years where they're either all gains or all losses. So this is where we are now. I would say by 2025, which is the next valuation next year, we'll talk again about asset smoothing, but we'll also give you some real numbers, like here's how it will work for your plan. But the next page is just an example. So this is not your fund. It's another one of my clients, but it shows how the asset smoothing works for them. So there are millions of dollars on the left axis there. There's a zero kind of right in the middle of the page. And for each of 5 years, we measure a gain or a loss. Now, that's not a positive return or a negative return. It's how did you do versus what you assumed. So you assume, is it 6 3/4 here? Mm-hmm. Or is it 6 1/2?
6 1/2.
If anything less than 6 1/2 is considered a loss. Okay. The way we look at it. So if you have a 5% return, it's positive, but it's still a loss. So it'll be under the line. So for this particular plan, 2019 was kind of a non-event. They had, a slight gain. 2020 was a loss, something less than what was assumed. 2021 was a gain. 22 was a loss. 23 was a gain. So that's kind of typical. Also, the significant loss in 22 was typical for this type of plan, which is measured on a calendar year basis. But what you see in the orange bars is the part that's recognized. For 2019, even that little bit, it's all fully recognized by the time you get to 2023. 2020, there's a little piece of that loss left. 2021, there's a couple slices of that gain left, 2022, et cetera. So what happens is it kind of balances out, and that's why it's called smoothing. So just an example, something to think about, and something that we will, I don't want to say have to, it would be very wise to adopt some kind of smoothing at some point in time. No need to do it right now.
And how does it impact the plan if you use the smoothing?
It's contribution smoothing. And so the way it would impact the plan, just kind of thinking out loud here, is that if you have a really bad year like 2022 for this example, the contribution would have tripled, for this one. So instead, you're going to increase the contribution, which is a good thing to do, if the market's down, buy low. But you're not going to increase it that much that you're, putting in all the money all at once. Over time, the effect on the plan is negligible because the only difference really is just market timing. Are you going to put in an extra, $2 million right now, or are you just going to put in an extra, $500,000 and then $1 million the next year and then $1.5 million? That's how it works. It goes in equal steps. So that's a good question. I mean, a really good question and what you should be thinking about. But yeah, over the long term, doesn't have any really positive or negative effect on the plan.
Okay, thank you.
May I ask a question?
Yes.
Catherine, are the benefits actually paid out of the plan or out of operating money?
The benefits to the LoSAP, the payroll.
They're not paid out of the general fund, they're paid out of the fund that's set up for LoSAP.
So they're paid out of the plan?
No.
No.
Yeah, I think they have PAYGO, so I think the commissioners fund the PAYGO, the daily, or the monthly payroll, plus they make a contribution to the trust.
Right.
Plus,
Right,
okay.
right.
So then my technical question is, if we were strictly on pay goal, does that count as a contribution to the trust?
It does. Yeah, that's a very good question. Yeah. And, one of the first slides we looked at showed how the plan went from 0% to 13%, et cetera. You don't want to be paying out of the fund because you're going to be losing ground. But at some point you will. That's the whole point of the fund, is to pay the benefits out of there. So, is that now? Is that next year? I don't know. It's something you can decide. But when you make a contribution, let's say you pay, $1.2 million in benefits, that when the county does the financials, that counts as a contribution, even though it didn't go into the fund.
But then hypothetically, sooner or later, what you're taking out of your budget as pay-go is going to get pretty onerous, right? Compared to where the actual fund itself stands because of its investments.
Right. And I would say, let's just fast forward to the next valuation. Let's say we run that and you're 80% funded. I really don't think there's any reason at that point to continue the pay-go strategy. You could. I mean, there's no rule that says you can't do it. But if you're 80% funded, then the fund is there to do what it was intended to do.
But if we were at, let's say, 40%,
Yeah, 40%. And I have some clients that are 20 or 30% funded in some plans that are relatively new. And they're taking benefit payments out of the fund. Of course, they're refilling it with their contribution, so it's equivalent to doing the pay-go thing. But yeah, 40%, I think you let the fund build up. And I've had this discussion with many clients, and what's the right funding ratio where you should start paying out of the fund? And I always leave it to them, but I say, 80% is where I start thinking about it. Some say, no, we want to wait till we're 100%. Some get to over 100% funded. And then I have to almost insist, well, if you keep doing this, you're going to be 300% funded in a while.
So, if I can ask another question, and it's maybe an ignorant question, but I hear this a lot. Fully funded, some people say that, hey, it should be, 100% funded, and that's great, or slightly higher. But what is the, I don't know, for lack of a better question, the safe range where, you're saying 80% funded, where you really, we're not in need to be putting more money into the fund where it can run on itself without
Yeah,
in
no,
trouble?
that's not an ignorant question. That's a very good question. I have quite a few answers for that. The way the funding calculation works is you're always aiming for 100%.
Okay.
So when you want to get there, that's part of the funding policy. You can say, well, we're okay if we get there in 20 years or 10 years or whatever. But you're always kind of going for 100%. Second part of that is whenever you get there, it's temporary. I mean, it's a moving target in so many ways, with the investments, with the life expectancy of the people receiving benefits. So 100% is just a temporary point.
Right.
You're going to get there on the way up. You're going to get there on the way down. So it's important to keep that in mind. It's not like we hit 100%.
100% and you're good forever, right?
But yeah, we just have a big party and everything's done. But the other part of that answer is, what is generally considered a healthy funding ratio is 80% and up. There's nothing really magic about that. Is 79% really that much worse? No. Now, for private sector plans, they actually have laws that say 80% is very different than 79.9%, which is kind of ridiculous. But, fortunately, this is not a private sector plan. But, I think bond rating agencies, which is very important, they like to see 80%. From my point of view, I like to see 80% because it makes the cost more manageable. When you're 40 or 60%, you have this huge amortization payment. When you're 100%, that's great, but the cost is really volatile. That is the most volatile funding ratio you can possibly have, because in one day in the market, your unfunded liability could go from 0 to $1 million, or the other way. But I hope that answers it sufficiently.
So by that statement, we're always shooting for 100, but are we safe to stay slightly below 100?
I don't know if safer is the word I would use. Costs are more manageable when you're like 80 to 90% funded. Okay. But when you get to 100 or even over 100%, we would recommend changing the funding policy to kind of preserve that surplus. Let's say you get to 110% funded in 6 years. So we would say, well, let's spread that out. Let's amortize that over 30 years so you're kind of preserving that surplus and you still maintain the cost volatility and the high funding ratio.
Okay.
Yeah.
All right.
I follow. Because at that point, your contributions are taking up the slack based on any market volatility?
Yes. Yeah. And if you have a plan that's well overfunded, which we do have quite a few of them now, we say, all right, spread out that surplus over 30 years. But the whole that pie chart I showed you earlier with the little blue that little blue section's still there. But when that amortization payment goes from positive to negative, it just offsets the blue.
Right.
And so if you're 110% funded, you're still going to have a contribution. If you're 140% funded, it's probably going to totally wipe out that normal cost.
Okay. All right.
Thank you.
And thanks for all the questions. I do really appreciate that. The worst meeting is the one with no questions.
You just feel like you're talking to yourself. It's like,
next page is actuarial assumptions. I mean, this is spelled out in much more detail in the report, but just to recap where we are now. Return assumption, which I had to ask about earlier. I should have just paged forward. The retirement assumption, people are assumed to retire when first eligible. To me, that's an overly simplified assumption. It's sufficiently conservative. I mean, if you assume everybody's just going to go out as soon as they can, that's going to cost more than if you assume they're going to wait 5 or 10 years. But the point with that is, at the bottom, all the assumptions are going to be reviewed. So we're going to do an experience study, take the recent history of the plan and say, well, is that really happening? Do you really have most people retiring when they're first eligible? If so, we'll just maintain that assumption. If not, we'll come up with a table. It's usually a table of rates. At this age, 10% of people retire. At this next age, 20%, et cetera. We don't know those numbers yet, but we will when we do the study. Mortality tables. Pub 2010S stands for public sector. The S stands for safety, as in public safety. And projected generationally means that for the life expectancy increasing over a very long period of time now is expected to continue indefinitely into the future by a small amount. So when you project something generationally, what we're really saying is, okay, well, the life expectancy right now is 85. Let's just make a number up. It's probably pretty reasonable. 85 years old. But as we do our projections, because every valuation you're projecting out 100 years and then discounting, but we expect it in 10 years to be 85.3, just for example. So that's what the generational projections do. Scale MP 2021 is just a mortality projection. That's what that stands for. It's just one of the available projection scales. But that's really come a long way for actuaries in the past, I would say, 15 years, because what we used to do is they would come out with a new table, and we'd say, all right, we're using the new table. Everybody's living 2 years longer. Put more money in the plan. Now, using generational projections, it's just fine-tuning every year.
Excuse me.
There's disability rates, withdrawal rates. Those will all be tested versus what's actually happening. And so when we're done that experience study, I'll come to you and say, here's what we think you should change, and here's why. And it'll be a presentation like this. We can talk about it, and we can make a decision then.
It seems to me that the cost of living allowance for a retiree, to me, it seems like you're not factoring in, or the industry's not factoring in, the ever-increasing cost of medical care for a retiree, housing costs, the way they've been running lately, grocery costs, they spike, seasonality, weather, et cetera. But that just collectively seems like kind of a low number. Can we talk about that a little bit?
Sure. I mean, well, there's two things here. These are the assumptions. So when we run our evaluation and we come up with that $9.2 million unfunded liability, we're assuming that everybody's going to get a 2.35% increase over time. The actual increase doesn't have to be that. But to provide a better, more generous, more reasonable maybe, COLA would be part of the plan provisions. We don't have it, as the actuary, we don't have any say in that. And I'm not sure who does have the authority here.
Well, in fact, with the benefit change, the amount of people receiving the COLA will be reduced. What we agreed to last year when we changed the plan was that people are receiving an increased benefit and will not receive a COLA. And the people who are receiving a COLA now are grandfathered.
But they will actually age out.
They will, right.
Okay.
So that the plan will not
Will not
provide
do
a
COLAs,
COLA in the future.
But I think my understanding then of the correct answer is it's just a made-up number. It's what the plan has decided the bump is going to be.
Yes, it's a plan provision as to what actually happens, which kind of sounded like.
But it's not attached to reality out there in the marketplace
It's,
necessarily.
whoever has a say, whoever's a stakeholder for that plan, which I'm not included in that group, that's who would
Okay.
make that decision.
Got it.
But I will say this, for people who are retired, they can still accrue credits.
Right.
So in some ways, that can be thought of as some form of a COLA.
If they're actively volunteering,
Yes, yes, if they're volunteering.
that would be the
Yep.
requirement, right?
Yep, my Uncle
Right.
Jeff did that. He retired and then he kept volunteering for another 10 years.
Got it. Thank you.
Yep. The last part of this is the cost and funding projections. So same color coding that we looked at early on, and my question was, well, we're 60% now, where does that go going forward? Couple really important things about this graph. Number one, if we fast forward to 2034 and look back, it will not look like this. That's one thing that is guaranteed. There's volatility. So this is just kind of like a weather forecast for next year, the Farmer's Almanac. This is where we're headed. In reality, those numbers will all be different, but this is where we're headed. It's really an evaluation of your funding policy. And your funding policy basically says, hey, we're going to be fully funded by 2031. And to the extent that there's favorable experience, unfavorable experience, the slack is going to be picked up by the contribution. But the policy says, yeah, that's where you're going to be. So that's great. Getting to 60 fairly quickly, and then from 60 to 90 within a reasonable amount of time, 5 years from now. That's a good picture. That's one of the best ones I've seen. The next page, and it might be the last page, is just the cost side of that. Well, how do we go from that $9.2 million unfunded liability all the way down to zero? Well, this is how. Contributing a 1.6 million or so each year in the amortization payment. So going back to that pie chart, it's color coded the same. So the red part of the 3/4 of that is the red bars, and the blue is the normal cost, and that is generally increasing over time. But then when you get to 100%, the red part goes away. You still have ongoing accruals, which means you still have a normal cost.
Well,
Yes.
guess I need a motion to accept the Boomersheim actuarial update
And valuation report.
and, yes, and valuation report.
So, so moved.
I'll second with applause.
I have a first and a second. Any objection? Motion carries.
Thank you.
See,
Thank
this is
you
why
for
you're here
not
to keep me
throwing
from falling down and
anything
hurting myself. Okay, and I think now we go into committee reports.
Okay, thank you. So for this past, since the last meeting, we transferred $5,288.46 to pay two invoices, Boomersheim July Services, $1,910, and Marquette Associates for quarter-ending March services for $3,378.46. As mentioned earlier in Pat Wing's presentation are shown there. The budget for the 2025 LoSAP contributions is $1 million, and the first contribution for the year will be made in September 2024, if not, actually, it may be next week, but no later than September 2024. Future meetings, October 25th, 2024, and December 6th, 2024.
Motion to accept the committee report.
So moved.
And I'll second.
Have a first and a second. Any objection? Motion carries. One more motion.
Move to adjourn the meeting.
What was
Somebody's got a
that?
second.
To adjourn.
Second.
Unless we just want to stay and have
Second.
a first and a second. Any objection? Meeting adjourned.
Didn't mean to wake you up.